Aditya, thank you very much, and it's always a pleasure to work with you. And I must say, you come out with very interesting and innovative ways of connecting with the audience and innovative topics, which are always topic which are hot for the day and very timely. So this one in particular as well. And so thanks for that, and also for the introduction for all of us. So I would like to welcome my co-panelists, Ashish, Saurabh, and Pranav. Thank you for joining and spending time. Unfortunately, Vijendran could not join us today from Sundaram. I mean, he has a personal exigency last minute, so he had to cancel that. But nevertheless, I mean, we'll start a discussion without wasting much time. And I heard Ashwin talk earlier on the plenary, and some of the things which he said very much resonate with what I wanted to mention. We are touching almost 1,000 AIFs in India today, with investments of over 290 trillion, or about 290,000 crores already made, which I think is quite phenomenal considering the limited period of time during which the AIFs have taken off. AIFs now invest in a wide variety of areas, including private and public equity, private and public debt, structured assets, futures and options, and also in a wide spectrum of sectors, including certain new age sectors. So my first question, which I'll start, which will be a little bit broader to all the panelists, will be that, crystal ball gazing, rather, gentlemen, from where we are today, what do you think are the opportunities for growth in the AIF segment? In the sense, how large is the opportunity going from here? And also my related question is, what are investors seeking for this segment to really exponentially grow? Ashish, maybe I'll start with you.
Thanks, Rajesh. And thanks for the fighting for having me here. I think I'll take the second part of the question first, Rajesh, which is, where are the opportunities? And I think, the demand that we're seeing in these segments, especially AIF, and, I'll speak more about that because my background's been in private equity and venture capital, is a derivative of just how, used Indian investors have become over the last few years to equity investing. So, you've seen the growth in the mutual fund industry that's become quite secular and widespread. And people have understand equity as a mode of value creation a lot more now. What that's done, I think, in my view, Rajesh, is that the supply of capital now is one more widespread in terms of just the number of investors. It's more secular, so it's not sort of in one region or one demographic, and it's way more informed. That's what equity investing and mutual funds have done to the end. And it poses a very interesting challenge and opportunity for investment managers like us. And I think a derivative of that is that sophisticated and informed domestic investors are now seeking access to asset classes, which they've not had exposure to, which are giving them a risk-reward outcome that, publicly traded instruments, whether it's debt or equity, are not able to provide. And we're seeing that level of sophistication. And I think that is really what's sort of driving the growth, and especially in the AIF segment, where I said I have experience. I think also, as investors and as fund managers, arbitrage is constantly vanishing, and we're constantly chasing arbitrage. And as capital markets get more sophisticated, people try and look for that on the private side. And in our view, there are, and my colleague Ashwin was speaking about this earlier, there are 4 or 5 very large segments we see, which have largely been governed by institutions, dominated by foreign capital, where we're seeing AIFs being formed and where we're seeing sophisticated investors and informed investors come and ask us for products saying, look, this is where we need exposure, right? Private and equity and venture capital, which is my bread and butter, that's a big area. And, we'll talk about some stats later, but, clearly private companies, high growth, and people want access to those opportunities. And I think the industry, especially over the last 3 to 4 years, has shown that, it can deliver stellar returns, often in excess of what public markets can provide. Real estate is a big area, and I think that's getting more sophisticated. It's a class of risk, again, which often the public markets will not offer, and people are demanding that. Structured credit in various ways and forms. I think it's existed for the longest time, but again, becoming more sophisticated, being offered as smaller units to a class of investors where these kind of products were not available. And the fourth area, actually, it's 4 and 5, whichever way we cut it, is buyout and special situations. If you look at alternatives globally, buyout has been the dominant category for decades. It's a very small category in India. It has the ability to generate exceptional returns for investors. And, generally HNIs, even HNIs in India have not had access to that, or, had disproportionately less access to that asset class. I see a lot more opportunity there. I see a lot more in special situations as well. Again, where large distressed credit kind of funds and, for foreign funds are played. But again, there is tremendous sort of return generation opportunity, and special sits, if you look at the global alternatives landscape, is extremely large. So I think overall, these are the 4 or 5 large areas where we're seeing people get more sophisticated and have an understanding and chase alpha. And then fund managers innovating and sort of bringing out more products. And, it's in sync with what Ashwin was talking about, what we're trying to do at Axis as well.
Sure, Ashish. Thank you. Thank you for that interesting insight. Saurabh, you want to share your thoughts and then request Pranav as well?
Sure. So I'll maybe, since Ashish has covered a fair bit on the second part, I'll probably, and I agree, I think all of these are very interesting strategies. It just offers very tailored risk reward for pockets of liquidity that do not have exposure to that through the regular, investing routes. Just crystal gazing into where this industry is. I think this industry is growing at 30-40% by most estimates, right? When we look at the entire mutual fund industry, we get to a number of 37 lakh crore that's raised and invested into Indian debt and equity markets. And if I look at just the PMS and AIF industry, in terms of just the capital that's been raised so far, it's around the 10 lakh crore number, where you have severe restrictions in terms of the ticket size. PMS, as we know, works with a minimum of 50 lakh. AI works with 1 crore sort of minimum ticket size. That's the 25 lakh just got raised into 50 lakhs. And second is a lot of, so it doesn't have access to the retail money. And second is a lot of institutions that have just started investing in this asset class are also restricted in terms of what percentage of their AUM can they allocate to a strategy like this, right? So despite a very nascent industry, I think it's already commanded a fair bit in terms of the allocations that's coming from sophisticated investors. And I think this trend will continue. And as innovation comes up, and as a lot more asset classes open up, I think the overall PMS and AIF industry will increase in size, and there's going to be a place for a lot more domestic players to serve the domestic market. Now, at InCred, we firmly think that the first bunch of investors that came into the country was foreign capital, right? Whether it's the foreign banks, it's foreign funds investing in real estate assets, investing into private equity, investing into credit transactions. But if you look at the last 3-5 years, as the industry has grown and a lot of homegrown funds have come up, raising money from domestic investors, that's where the true, I would say, non-FX, non-foreign exchange led transactions are done, because everything that comes in with foreign capital also comes with a 4 to 5% rupee depreciation implied returns, right? And then you're competing with a lot of non-INR capital against this. So I think a lot more capital will be coming towards the PMS and AIF in the next 5 years from both domestic institutions and domestic family offices and private money.
Interesting. Pranav, if you could please add on to this.
Yeah, well, I think I'm very happy to see so much is covered. I'll just speak from a fund manager's point of view. We've seen 3 very distinct cycles in India over the last 20 years, roughly. I think I totally agree with Ashish. CDC was one of the pioneers in the early 2000s to mid 2000s. But if you were a fund manager back then, you had almost no access to capital in India, and all of your capital came from outside, therefore. And that's why the industry was so small. Fast forward 15 years, we have a record being set every year. What we can tell you for sure is the demand for products that AIFs are launching is now across the country. We have inbounds from northeast of India, from Calcutta, from parts that were formerly not part of our world before, the technology, the tech and early stage VC piece. But there are 4 or 5 things that are coming that I think will signify even more flows going forward. For one, I think the largest financial institutions in the country will now start structuring fund of funds that channel more capital from further corners of India, not just the large bulge bracket HNIs, UHNIs, but also investors who want to invest smaller tickets. And we think that should be spread across the product suite, from tech to buyout to real estate to credit. And we think that's a great sign for India, because overall our equity positioning, our equity presence, our equity weightage has to grow from local capital, not just global. Second, I think India's weightage today globally is still 3% of allocations, right? Our GDP, while it's close to 3 trillion and we're either the 5th or the 6th largest country, give or take the quarter, we're still only 3% of the biggest global allocators positioning in across economies. China's around 10, 8, 10, 15%, depending on who you're talking to, with tech or non-tech. So now we need, with this challenge that we have to face, is how does India become 5 to 10% of global allocations? And historically, if we look at the US, we look at China, we look at Europe, any country that's got into double digits in terms of allocation bandwidth, they've had to do it by pushing the gas on local participation in the equity markets. That's the only way to increase the equity market cap, and therefore the percentage that global allocators can channel towards your country. So I think we are in that stage today, where we're going to go from roughly 3 trillion in market cap today to, we have to go to 30, right? We have to grow 10x. And that means the allocation global investors will make to India can grow from 3% to say 7, 8%. And I think that's going to mean the entire culture of allocation in India has to fundamentally change, which is great. I hope all of us get to play a significant role in that big wave that's coming. And I think hopefully retail will play a role as well through structured fund of funds that Indian institutions are stewards of. Lastly, I think the most important thing for us is so far we've had 3 very important demerits to growing large value assets in India, disadvantages rather. One is we haven't had access to quality equity capital over decades. It's changed over the last 15 years, but that's new. The Infis and so on, the Tatas, the Wipros, never really grew with high quality equity capital the way their global peers have. So I think this changes how assets will be built in India. Second, I fundamentally think it's gotten easier to take assets public. It's easier to get assets restructured. Well, of course, there needs to be more improvement. The levers that make the markets more efficient have only gotten more powerful, and that's great for all of us in the markets. But third, the most interesting thing maybe is, if we don't have an active presence of fund managers working with regulators to continue to expand the markets, then we would have lost a decade, because this is really our decade to capture. So I think across all levels, from regulation to the innovators that we work with every day, we're seeing fundamentally AIFs play a almost fabric level connective tissue role to bring all of this together. And I think that's why, for me, this decade is really important. I think we become a systemic part of the Indian economy very quickly.
Very interesting and well said, Pranav. And I'll come to regulations later on, but I would want to stick with you and continue with my next question, which is, if you look at overall investment perspective, there are a lot of hot sectors today, whether it is technology, cyber, in manufacturing, that's the Prime Minister's focus area, innovation, alternate energy, retail, e-commerce, I mean, you name them. My question is, in terms of upcoming focus areas for AIFs and PMS, what do you think could be one of the certain few areas where AIFs and PMS will look at focusing?
Yeah, I think that's great. I'll split AIFs and PMSs apart, because I think they both fundamentally have different value props. I think on the PMS side, well, I don't run a PMS myself. We have good friends who run large PMSs like Marcellus, for example. Continuously we hear from them that the demand from their investor side is fundamentally very simple, like a 3 ingredient bucket. One is they want high quality people who are consistent in the advice they give and how they select companies and ideas, right? And when things are good, they don't get too aggressive. When things are not good, they explain and are transparent about how they will recover or how they are planning for that downturn. So I think the demand on the PMS manager today I think we are seeing a very new demand. It's no longer just access and selection and so on. It's the full experience, right? And that's why we're very happy to see that large PMSs are growing unexpectedly fast from 0 to 15,000 crores, say, for example, in 3 to 4 years. And I think that's a good sign that if you're building a franchise for the long term, PMS is a viable business, a viable category, and there's demand for those services across the country, which is advisory led and so on. So I think it's a sign of a very important step forward we've taken. So the fact that is established today is for me a very credible part of the ecosystem. Now the demand on the PMS manager from the ideas point of view has to expand. Unfortunately, PMS are still being very biased towards quality. They're still picking those same bucket of large caps. When a good analyst report comes out on, for example, Spec Chem became this big thing over the last 6 months. Everyone is buying Spec Chem. So it's kind of a herd mentality still. And we are not seeing that, I hesitate to use the word activist for PMS, but we're not seeing that outlier thinking in the PMS category still. And I think that's important because that's where the alpha in the public markets comes from, by picking ideas that are still not mainstream and pulling them up to mainstream by consistent coverage. So I think PMS managers have a role to play, not just in following a herd and being part of it, but expanding what the definition of high quality is. And we look for, I think that happens specifically this decade. A lot more of them will take those positions. Coming to AIFs, we still don't have the AIF culture that's spread beyond tech and mid-stage PE. I'm looking forward to the day where we will have multi-billion-dollar Indian private equity firms that can command a large outsized presence the way the KKRs and the General Atlantics and so on have done in the US and the rest of the world. I look forward to the day where we have AIF managers, India, domiciled here, raise capital here, and can build companies beyond tech. I think we need a massive amount of Indian capital to support everything from manufacturing to chemicals to biotech to logistics. There are a dozen categories that are doing really well in the country, but they still starve for capital. And they're still largely ignored by funds like us because our mandate is tech, right? And of course, tech works certain ways. We've clearly seen the up and down over the last 2 years. But in the non-tech piece, AIF is becoming more mainstream, building, for example, consumer brands, building logistics companies. We look forward to the day that AIFs expand there meaningfully as well. So I think the first wave of AIFs have been dominated by tech and some other categories, obviously. This decade, I hope there'll be large PEs, guys we could look up to as we build our companies up to IPO. That handshake between us and the mid-stage AIFs, I think that's something that we're looking forward to building together. So that I can keep going on, but I think there's a lot of things to be built still. Very exciting things to come.
No, absolutely. And Ashish, from a PE and a VC point of view, any thoughts you would want to add on that? As Pranav mentioned, beyond tech, what are the sectors you would think?
No, I think, the first wave, as Pranav said, has been tech-dominated, VC, to some extent, some growth PE. Not to say that the opportunity is less. I mean, that opportunity, let's admit, is very large and still to be tapped, right? I mean, 2021, you're talking about, just VC funding in India being in excess of $35 billion, PE being, an equivalent amount. So that's $70 billion coming in 1 year in just those two strategies, which is still foreign capital dominated. So I think just the scope for participation of domestic capital, very, very high. Just across, what we call startups, this is Pranav's domain, and growth capital. There are about 50,000 companies in India where the collective market cap is about $400 billion. So just that asset class is so large, and it's as we've been saying, it's foreign capital dominated. So it's a very large area. I think the other thing is, and it's again an extension to what my fellow panelists have been saying, the way some of the best alternative assets, different people have done it in different ways. But some people have just specialized in sectors and then built different pools of capital which can address the needs in those sectors, right? So early stage, platform building, there is a pool of capital available provided there's a quality business. You want to add more leverage, you're getting working capital heavy, there's a structured credit fund within the same thing. So it's more relationship driven. You build an understanding around key industries, and then you offer not one pool of capital, which cuts all needs, but differentiated pools of capital to that business. And that's how you start differentiating yourself as an investor. The business wants to make an acquisition, you have a special such funds to address that, right? But it's very, very industry specialization driven rather than, one product and I'm going to, try and cut all needs with that. And I think it's what Pranav was saying, right? I'd also love to see the AIF landscape get to that level of sophistication where managers emerge who've got products which are ultimately targeting good businesses. What the need of capital there is in what shape and form. I think that can be tailored.
Yes, thank you for that. And as I said earlier, my next question is on regulations. And in our country, all of us are some kind of legal experts, and we love law irrespective of what field we are. And this is quite important for the AIF industry also, because in the recent past, we have seen, with the objective of investor protection, increasing compliance, governance in AIFs, there's been a lot of changes which SEBI has made. And some of them are increased disclosures in the private placement memorandum, appointment of compliance officers, routing of applications to merchant bankers, the investment charter, and also proposed changes as per various press reports, which include asset and liability segregation amongst different schemes, outer limits for closed-ended schemes, and also various steps to ensure that there is no mis-selling. So a lot of changes in regulations and more expected to come. There's a worry amongst certain section of investors that probably there's an over-regulation of the industry, and the industry cannot be compared to mutual funds for many reasons. Given the limited time, can all of you share one or two key areas where you think the regulations need to change or there needs to be an improvement, etc.? Maybe Ashish, starting with you, and then Saurabh and Pranav as well.
Sure. Rajesh, not an expert on regulation, but I'll take you to. I mean, the growth in alternative assets globally, if you see, right, like these asset classes have existed for very, very, very long. But there were three major events from what I understand, which really led to the growth. And the first two were the dot-com bubble and the global financial crisis of 2008, because companies went private and investors did not want to be, or had a pool of their capital which they did not want to be subject to the same levels of volatility, and alternatives allow you to do that. And my colleague Ashwin spoke about that. I think at a fundamental level, I believe at whichever level, regulations has to be in line and respect that. If you're going to then subject unlisted instruments to the same level of scrutiny, you're taking away the inherent need from investors and the rise of the theory of why these asset classes exist. So I think that's quite fundamental. On the other hand, I think, look, I mean, we all here know that managing third-party capital comes with a very high degree of fiduciary responsibility. The good thing is, and again, I speak more of PE and VC asset classes, the foundation of those asset classes was laid by foreign capital and very sophisticated foreign limited partners, where I think very good standards of governance have already been set. And there are fund managers who are sort of used to that. I think that sort of is a good platform where people can today claim that they stand up to global levels of diligence. I think as a general direction, just keeping in mind of not subjecting and sort of painting everything with the same brushes is fundamentally important.
Thank you. Saurabh, your thoughts on regulations?
Yeah, so I think, regulation by and large is good, right? I mean, it kind of legitimizes an industry when the first bunch of funds come up and people who are serious about this industry understand that if you're not regulated, you'll have some bad examples and investors will lose money or the fund will not do what it's committed to do. So regulation is good. And generally, we by and large think that some of the regulations that have come up in the last few years are to increase the transparency towards the industry and in the eyes of both the investors and their advisors. We do think as a house that there are quite a few things which we would like to lobby for changes, and especially on the debt funds the category 2 debt funds. One is the tax rates, which is mutual funds on the debt side are subject to a much lower tax rate versus an AIF. And by and large, they kind of achieve the same purpose. So why is the tax rates very different? Or for example, SEBI prescribing what percentage of the portfolio should be in listed versus unlisted instruments, right? I mean, these are all subject to the manager's discretion. And as long as like-minded investors are willing to commit to that strategy, then that's something which SEBI shouldn't dictate the percentage of listed versus unlisted investments into a fund. So I think there are quite a few things where they need to open up to the idea that there could be a totally different strategy from an existing mutual fund. And as long as it's well disclosed and investors are willing to back it, they don't need to regulate it at a central level and let the accredited investors or people who are eligible to participate in that fund kind of make that decision. So I think these are some of the things which we think should come in. I do think though that some of the other regulators, for example, whether it's RBI, whether it's EDA for the purpose of insurance companies, they all need to come together to say whether the risk-weighted assets of a banks that are investing into AIFs should be any different versus, let's say, if they're investing in a regular fund, or for EDA to say X percentage of your corpus can be allocated to alternatives. So some of these will eventually happen with passage of time. But I do think it's not just SEBI as a regulator, but EDA, RBI, every single regulator in the country is responsible for ensuring this industry or this asset class gets its due recognition or kind of becomes more mainstream than what it is. So for sure, good to get regulated, and similarly, lots of points that we would probably want to lobby and say this should change in the longer run for this industry.
Good point, Saurabh. Thank you. Pranav, you have some thoughts on regulations?
Yeah, very quickly, I think we've had a good regulator overall compared to what it could have been. It could have been much more controlling, could have been much more permission-led. So I think largely, if we have to account and give credit for the growth that we've seen in the AIF category, it's thanks to good regulation, thanks to obviously good leadership at the center, and of course, a good coordination between the other regulators, central bank, and so on. Where I think we have reached today, I can tell you for sure, in meetings across the country, no one expected the AIF category to grow this fast. So it's largely been a positive surprise. And of course, the multiplier effect that AIFs have had on job creation and inflow of equity, FDI. We had a record FDI last year, largely attributed to tech, VC, and PE, of course, the value creation in the public market. So I think the AIFs now have to be viewed as a systemic player, which they are getting to slowly. And therefore, the few niggles here and there, right? The over-policing of ratios and the concentration limitations and so on. I think if we're able to make a concerted effort, those should be eased out and more trust should be placed in the fund manager. I think that's the transition we are making. And in the backdrop of course, India's economy is moving places. Our allocations globally are going up, like we discussed before. So I think it's just a matter of time. I hope we make that transition quickly. And then it's up to the industry, of course, to prove that trust was well placed. And I think we're in a good position to do that.
Probably, what they have done with the GIFT City is to alluding to what you mentioned, and maybe that's a test case which they will broaden to the whole of India. Now, sticking to some of the challenges, apart from regulations, fund managers and investors face various challenges, whether it relates to the macroeconomy, the structuring of investments, the market pricing, etc. There could be many challenges. According to all of you, if you can name one or two areas of challenge for fund managers and for investors, which need to be considered as we move forward, apart from the regulations. So, Ashish, maybe you want to start again.
Sure, thanks, Ajit. I mean, quick two things for me on that, two challenges from an investor's perspective, two from managers. I think, and this is more AIF, I think just making investors understand, what a closed-ended product is and that you're committed to a strategy for a longish period of time still requires a lot more education. It's fundamentally different from, other asset classes, liquid asset classes. I always explain it. I mean, it's a PMS and listed is sometimes like watching a movie. You don't like it, you can walk out. AIF is like signing up for a football game. You don't walk out midway. You've got to play the full game. And, if you like that, then that offers a level of satisfaction that's higher. I think the second is longer tenures. You're committed to strategies. And I think, just more education on that from an AI perspective is an ongoing exercise. And I think that is bound to continue. I think from a manager's perspective, balancing domestic flows and foreign flows, the asset classes we're investing in, it's still subject to significantly higher foreign flows, and, how we sort of match domestic flows, and it, ultimately affects the prices of assets that we're investing in. I think that's quite critical. And I think investment mandate, stated versus actual, and I think that's what's going to separate a lot of people, which is, what have you stated and then what are you doing? And just having that level of discipline, extremely important from a fund manager's perspective.
Pranav, thank you. Pranav, your thoughts on this, please.
Yeah, I think it's mostly to do with the micromanagement of how we deploy. I think Ashish and Saurabh covered that well. So, for example, as a fund manager who's got 6-7 schemes, trust track record for close to a decade now. We passed the exams, etc., etc. Now, why are we not allowed to have a single company SPV? So, say we have a good company and 4 of our LPs want to invest in that company and have us manage it. We're already required to be PMS aligned and so on. That regulation came a couple of years back, but we're still not allowed to buy the stock of a single company, right? And it's an unnatural restriction, if you ask me. And then we have to get creative with going to Singapore, and then it unnecessarily diminishes the powers of a good fund manager in the country and the ability of a good company to raise capital from Indian investors. These limitations don't apply to foreign investors, for example. So I think we have to reach a point where, like I said before, there's an element of trust between the regulator and the market participants, that we're doing these things with the right framework in mind. We have adequate boundary conditions, and we have to be allowed to be run our portfolios the way they are run globally. So I think we'll get there soon, but again, just minor things that get in the way for now. I think long term, again, we're fairly optimistic that regulation is in the right direction, and of course, it's been very consultative, very positive to work with.
Yeah, thank you for that. Saurabh, your thoughts on this?
Yeah, I'll probably mention 2 points. One is for specifically closed-ended funds. I think it's the liquidity. I think Ashish alluded to this earlier. And maybe at some stage there is there's a secondary market for unlisted companies. Maybe there's a secondary market that gets created for illiquid units of a particular fund, right? So I think that's going to make a big difference when people think they want liquidity and they can kind of get out, maybe at a discount, maybe at some level of haircut to the NAV. So I think that's one. And I think the second is the standardization. So I think as an industry, we still go through every PPM scheme needs a specific approval, and it depends on who's the relevant SEBI concerned officer and what their sort of overall views are on certain languages within the PPM scheme, to the entire administration part about fund accounting and how do investors get a particular statement of a particular fund. So a lot of the standardizations can be made across the industry, so that if me as an investor is investing in 10 different AIFs, I know how to monitor and sort of look at them in a consistent manner, rather than every sort of fund reporting it in a different way. So I think some more standardization will probably go a long way in terms of more investor appetite towards this.
Interesting. One of the things which we haven't mentioned about or spoken is on the increased focus on ESG, especially globally, and also with mutual funds. ESG and sustainability, and this is a demand partly coming from regulations, partly coming from demand from investors. Do you think in the AIF world, we will see that anytime soon, whether on a voluntary basis or on a forced basis, schemes or funds which are focused on ESG and sustainability? So Pranav, maybe starting with you.
Yeah, I think that's really important. India has this unique position in the world where you just couldn't do business here if you weren't already ESG sensitive. You can't take risks with people's data, for example. That's always been true here. You can't take risks in insurance, for example. It's tightly regulated. Obviously, that's very strictly enforced. So we have no choice if we are in asset management to be very, very clearly focused on E, S, and G. Of course, E less in tech because the environmental footprint isn't as high as other operating sectors. But overall, this is something that we thought was very natural, especially to venture capital. So that's why we've taken ESG very seriously since we started. We launched our first fund in 2015, and we recently got approved as the first VC signatory to the UN PRI from India. We think that's not atypical now. Almost every Indian AIF manager we know in tech is gearing up to become scrutinized as far as ESG lens is concerned, and make a very simple, straightforward claim to being ESG aligned going forward. And I think that's a good thing. It allows India to leapfrog from a perspective of global allocators. This is an advantage we have against other emerging economies, for example, like Indonesia, China, large part of LATAM and Africa. So I think this is India's moment to shine. We really should grab that and take full advantage of it. There are obviously execution problems in ESG. Some of the frameworks built for ESG really apply to large public companies. They're very useless when applied to small private companies like what we deal with. It's not my opinion, it's a truism. We've tried to apply those, they make no sense at all. There's some amount of refactoring and alignment required, but again, that's not something that's impossible to do. There are enough ecosystem players to do that. I think we can have a very thriving industry that's ESG forward, with India setting a new bar for what sustainability looks like. So we're excited. We think it's a good thing when applied correctly. We think it's a good thing when contextualized to India and the asset class specifically. And we think it's a good thing if India is able to make a collective positioning for the entire country's asset management as far as global allocations are concerned.
Thank you. Ashish, any quick thoughts from you on ESG?
I think two quick thoughts. I mean, one, the G is non-negotiable in India anyways. You can't compromise on it. Good fund managers have always known it, focused on it. E and S is very subjective. It's, it depends on what your investors are asking you to do. Will we see more demand? I mean, fund managers, are just going to be more conscious about it. Whether we'll see investors demanding products, I think we're waiting and watching. I think some part will be driven by regulation, some whether investors want their portfolio managers to really manage, that aspect apart from returns for them. And, globally, the jury is divided on that. I would say still behind, the global flow of capital into ESG. But, it's going to come in phases, in my view.
I have one question which, one of you could answer. Sorry, we have limited time, but I still wanted to keep that. Is that, speaking of technology, and if we look at in-house, then where do you think will technology play a role in-house? Whether in terms of fund management, fund operations, investor reporting, where is there a greater need for technology? And again, crystal ball gazing, where do you think technology will play a bigger role? Any of you, please.
Yeah, I can take that. I think the holy grail is when we have transparent full stack reporting, like companies actively fill in invoices, orders, payments, vendor allocations every day. That bubbles up to the investors, all the shareholders, and that bubbles up in our reports to our investors, right? And then so on and so forth. But I think that's a long way away anywhere in the world. No place in the world has had that full stack flow that way for many reasons. And I think where technology plays a role now is, number one, for sure, in helping the fund managers ourselves, working with our regulators and making sure that the flow of information, the filings, and so on become totally run by machines. So, for example, when does your PPM get filed versus when does it get, how many days you have for review versus when does it get approved, and when is a deemed approval that's come by default. All that has to be run by logs and so on. And I think that's already starting, where there are already some things that are surprisingly under consideration for deemed approval, which weren't even 5 years back. So I think technology plays a role in making the interface between the system and us much, much clearer. I think then with us and our assets, our portfolio, and then hopefully eventually over the long term, a full pipeline. But until then, I think we have to use technology realistically and not have imaginary issues like blockchain and all, for example, a long time ago.
I think what you have said is quite exciting for me as a professional. I mean, I thought you might say something of use of technology on fund management, but when you talked about regulations and reporting, it was exciting for me and all ears on that. Look, I think Saurabh, Pranav, Ashish, all of you have given very valuable insights on this panel today. I'm glad Aditya has recorded this. It is going to be available on YouTube. So those of us who couldn't attend and listen will be able to do that at a later point of time. Very useful insights from all of you. And I'm also sure that if somebody listens to this after 3 years, 5 years, whenever, it will very much resonate in terms of what you all have, predicted and shared your views on the future in terms of what is actually going to happen. So once again, thanks to all of you, Saurabh, Pranav, Ashish, for spending time on this session. I enjoyed it very much, and I'm sure the audience did as well. And with that, Aditya, back to you.